Hi, Eric. Could you please introduce yourself and tell us how it did happen that you're a senior ETF analyst for Bloomberg?
I was started my career as a journalist covering the financial investment world through Institutional Investor magazine. And one of the assignments I got there was to cover funds at a newsletter called Fund Action. So I had this little base of mutual funds starting out my career. And then I went to PR and did a stint in data. And when I was when I joined Bloomberg, 21 years ago, believe it or not, I was in PR for a couple of years, then went to data. And in data, I did mutual fund data. And then I ultimately got assigned to ETFs. So in the Bloomberg terminal, we track like the expense ratio, the name of the fund, the shares outstanding, all that stuff. So just sort of building out the DES pages of mutual funds and then ETFs. And when I looked at ETFs in like 2006-ish, I was like, man, these things are going to be big. So I really just started to become an expert in all things ETF over the next like 10 years. And ultimately started doing some, writing on ETFs for the terminal, did some TV hits, some radio, and sort of became known as the ETF guy. And then when Bloomberg Research, which is called Bloomberg Intelligence, started as a department in 2000, I want to say 10-ish, I contributed to them a little bit, and then they asked me to join fully. So I was asked to come in and sort of write for them, and then ultimately lead the ETF research group within Bloomberg Intelligence. And so for the past 5 years, I've been writing about ETFs, but I've been doing the same thing for 15 years. Now I'm sort of doing it probably in the right spot, which is writing research notes, helping to build out functionality on the terminal sometimes, our dashboards, which are the clients like, and then going and talking about it. If somebody inside Bloomberg in the media has an ETF story they want to talk about, me and my team are very good at going on and discussing it with them. So I would say I'm sort of ETF pundit, expert, research guy, and that's how I got there. But it wasn't like I went to research right off the bat. I did a little journalism and data before that.
But to me, it sounds like a dream job. And from my perspective as individual investor, that you have access to the Bloomberg terminal is really amazing. And by the way, are you only focused on the ETFs registered in the USA, mostly in the USA, or also you are following what happens, for example, in Europe?
So I'm probably 90% US centric, but we have someone in Europe, Henry Jim, and before that Athanasios, who cover European ETFs. So they're the experts there. And then we have somebody in Hong Kong, Rebecca Sin, who covers Asia. So they're going to be specific to those regions. But I learn from them, and I certainly know those places. I've traveled to Europe a couple times and gotten to know the industry there. It's different but same. And then in November, I'm going to Australia, actually, which will be the first time I'm going that far. I'm not going to Hong Kong yet because it's just the quarantine, and it's not quite easy to get in and out. So I look to get over there more and learn more. But I'm certainly, I'd say 90% of my tweets and my notes are US.
All right. And by the way, I'm Polish, although I lived for 10 years in Belgium. And what I found out, and correct me if I'm wrong, but I think you have some Lithuanian origins, right? I'm just asking because I don't know if you know a bit of the history between Poland and Lithuania. So that was just amazing to find out that you have some origins from Europe already.
Yeah, I wish I knew more. I'm probably going to visit there someday. I want to go there, but I'm third or fourth generation away. But my grandmother, I think the closest to Lithuanian culture I got was my grandmother, and she would have Christmas dinner, and she would have pierogies, blintzes, some stuff that you don't see that often. And
sure.
She had a mug that had the Lithuanian flag. She was a little more into it than I was, but I'm also a decent basketball player, so I think I inherited. Lithuanian always punches above their weight in the Olympics. And there's this player in the U.S., Balchunas, which I believe my last name, it came from that and sort of got morphed into Balchunas.
Okay.
So anyway. I definitely get in touch with my culture when I watch basketball because there's usually a Lithuanian here or there.
Yeah. Okay, let's talk about your latest book, which is titled The Bogle Effect, How John Bogle and Vanguard Turned Wall Street Inside Out and Saved Investors Trillions. And the book is not just, as I thought initially, that it's just the Bogle's biography, but to me it was really very impressive because it's more like a semi-documentary book, and you have did a great job interviewing so many people, including Jack Bogle, and also, I don't know how you did it, but Warren Buffett even is in the book. So my first question is, what is the Bogle Effect? If you could just quickly explain us.
Yeah, this guy Jack Bogle set up Vanguard, which is what a lot of people know, that company, and he set it up where the fund investors own the company. And that one decision in 1974 to set this company up like that changed everything. It took a while, but it ultimately changed everything because it allowed Vanguard, every time they got a lot of assets, the shareholders, who are the investors, voted to lower the fees because that was in their self-interest. So the fees slowly came down over 45 years. And now they're like, you can get a broad market exposure to stocks and bonds for like 0.03%, right? 3 basis points, as we say.
Yeah.
That once it got below 10 basis points in like the 2006, 2007, the flows really started to come in. And once the flows started to come in, everybody else has been forced to get cheap and offer cheap index funds and cheap ETFs like BlackRock, Fidelity, even Goldman Sachs, JP Morgan, Schwab. And when they do, they get assets. So what would happen is that the Bogle effect to me is not just that Bogle set up Vanguard. Vanguard became a huge success, but it's the impact on everything else as well. Most of the money invested today in America goes to either Vanguard or people who copy them. Then you look at Vanguard as getting into the wealth management business. That's going to be interesting. Vanguard, I think, also changed behavior. I think a lot of advisors now are more disciplined. They don't sell as easily. I think a cheap index fund makes that easier. I also think, like in the case of trading and behavior, Bogle was very much against trading, and I look at that a little bit. And he would have obviously not appreciated the whole like meme stock thing, but he didn't like trading in even big ETFs like SPY. But ultimately, this guy purposely wanted investors to win and to have cheap products. And everybody else copied Vanguard because they had to. And most of Wall Street's general inertia is to see how much money they can make. And there's nothing wrong with that. It is a business. You have shareholders. And in the book, many times I talk about how I would have done the same thing as active mutual funds. I wouldn't have shared economies of scale. I wouldn't have lowered the fees. I would have just loved the money. They got really, really wealthy, and they made a lot of money for many years. But Vanguard had just totally disrupted them because people just sort of waking up being like, wait, I'm paying 80 to 100 basis points to underperform when I could just buy the index at 5 basis points. All of a sudden, it's like it's a no-brainer. So Bogle won the hearts, minds, and dollars of the American investor, and it's slowly spreading it overseas. And so this is the Bogle effect, and it's going to have a profound effect on investors and the industry. And I find it interesting. I also found it just, again, unique and interesting that nobody copied Vanguard structure to this day, yet it has such a big impact on everything. And so I wanted to trace it out because I see the data all the time. I'm an analyst, and I'm just like, man, a lot of times I look at the data, the annual flows, and I'm like, damn, almost all this, you pull the thread on it, and you end up in 1974 in this guy's decision to set up a company that was owned by the investors. Way more important decision than indexing. Indexing is almost just a lucky byproduct of what Vanguard structure, which again lowered fees. If indexing didn't exist, I think Vanguard would be very big active manager because they'd have cheaper funds and they'd outperform more. So it's really about cost. That's why I think Bogle's mistagged as the father of indexing. He's really the father of low cost. And I wanted to set the record straight on that as well and really just look at how the big trend and the one he set off and the one that's going to keep going and going is high cost to low cost. And it's because every other trend there's some nuance. Active to passive, ETF, mutual fund. Some of these things are a little more, there's more gray area than it's not as clear. But what's clear is people now want everything to be cheap. And who can blame them? It really adds up over the years. Every little basis point counts, especially as your money starts to compound. So I also thought he was an interesting character. I interviewed him 3 times before he passed away in his office. And he wanted to debate and spar on these different issues going on in the financial arena. And so I had really good, lively, like 3.5 hours of fun debate with him. And his last interview was 6 months before he passed away, and he was pretty prophetic. And I remember after he died, I said, yeah, man, I really should get some of those words on paper. So it was the combination of the data I had that blew me away, plus the audio of the actual guy. And so I put those together, and I interviewed a bunch of people, 50 people, in fact. And I wanted it to read like a documentary, like a VH1 Behind the Music or something, because I was always surprised nobody made a documentary about him. It's just baffling to this day. There's documentaries on way lesser important things in the financial arena. So I was like, in fact, I actually pitched this book to somebody recently. I'm like, if you want to make a documentary of this, it's already written. Like, as you read it, I'm the narrator, and these people come in who are not me and give their take on it. And it was written to be exactly like a documentary. So I'm glad you said that. So maybe someday it will, but this is sort of why I was motivated to do it. I thought some people know Jack Bogle, but even those people, I don't know if they know the extent to which the impact he had, or the extent at which indexing really is getting way too much credit for the index fund revolution. And I think I communicated that well in the book, and also just a character study of somebody who is very unusual for this industry, a weird guy.
Yeah, you put a comment in your book that Bogle was similar to Steve Jobs, of course, in different industry, but as, for example, Jobs, he didn't invent the personal computer, neither did Bogle invent the idea of indexing.
No,
so
that's right.
My question is, in the end, how he was able to sell such a, let's say, boring idea of selling the product which is giving you average results? Because that wasn't that, I mean, now we can see it's so easy, right? But in 70s, that wasn't that obvious.
Yeah, you didn't have the internet where information was available. People didn't realize their active funds were not that great. And also in America, we want the best. It's like Top Gun and Maverick and all that. Like, it's in our culture to be like number one. And active funds seem like a better way to be the best. So he had to sell something that seemed communist and average. So I have a whole chapter where I go and talk about the many ways he had to labor away and try to make cases for indexing. And it wasn't easy. It also wasn't easy because when the index fund was launched in 75, and I think it was 76, they took all the commissions away. In other words, Bogle was one of the first people to not use your money to kick a broker, to give a kickback to a broker, which is how much of the fund industry worked and was built, by payoffs, essentially a bribe, to be honest. He didn't do that. You had to leave the system and go to Bogle if you wanted his index fund. That was pretty ballsy, in my opinion. That also increased the difficulty of selling it because you had to sell so strong that somebody was willing to leave the whole brokerage system and go right to Vanguard to buy it. And so it took a while. And so a couple of things he did was he said, here's this chart of a growth of $10,000. Here's if you get 7% a year, and here's if you get 5% a year. He said an index fund will give you 7% a year. That's a 60-40 with no friction, no costs, no turnover, no trading costs inside the fund, and no expense ratio. 5% is when you add in the manager's fee and the turnover inside, the trading costs. You take 2% away. It doesn't seem like a big deal, 5%, 7% to most people. But as you compound, in 50 years, on one you have $350,000, and the other you have like $150,000. Huge gaps. That chart, to me, did a lot for him. It did a lot to sell his case. I also think over time, while an index fund may seem average, the longer you hold it, the more it climbs the charts because active funds tend to fall. So an index fund tends to be in the top 10% of all funds over 20 years. So it is sort of a top manager. In fact, he has this fun quote saying, I had a dream. I've had this dream where I didn't tell anybody it was an index fund. I said I managed it. And after 20 years, I became the greatest fund manager of all time because my fund was at the top. And it's an interesting way to put it. Yeah. So it was a way to win, but it doesn't seem like it. And it just, you had to sort of shift things in people's minds a little bit. And he did. And I think over time, people's experience, I think, also helped. They saw active managers maybe not helping them in a bear market. And they saw index funds doing very well in a bull market. And, you know, experience and a lot of the media started covering it. The internet kicked in. That helped a lot. But it really took a while. I also think what he did that was really smart was he would say, look, the market seems like a casino, but here's all that's going on. It's a circle of people trading with each other. So half the people are going to win, half will lose. And then if you take the cost away, only a third can win post costs. And then as the year goes on, that third becomes less and less and less and less until there's really no winners. And that's just the math of it, right? And we're not here to beat the other guy. All we have to do is hold these companies for 40 years or a long time. Because I think what he also did was he say, there's two kinds of return. There's the investment return of a stock, which is the cash flows, the value created by all these people going to work every day. And ultimately, you get a dividend, right? And their earnings can grow. And right, those two things make up your investment returns. And those are pretty steady every decade. That is investing in American capitalism. That's why Buffett and Bogle both love equities, but do not like commodities, because there is nothing like that in commodities.
No dividends.
Right. So he was just like, stop pretending you have to beat the other guy or whatever. Just lock into those investment returns and let them do their magic. But what happens is every decade, like the stocks go up because he called that speculative return. And it makes it look like a shiny object, but then they crash and people kind of buy high, sell low. And he's like, let's forget speculative return. That's going to come and go. When you add in speculative return over the decade, stocks are up one decade, down the next, up the next, down the next. But if you remove the speculative return, the investment returns are steady. And I think he also tried to get people to say, that's what we're doing here. We are not trying to beat the other guy. We're just, if we all invest together in these stocks, we will win long term. And that was a way to, I think, say, okay, if I can sell you on that, what's the best way to accomplish that? A cheap index fund. So I go through a lot of these ways in the book that because one of the stats that blew me away is 97% of Vanguard's assets came after he stepped down as CEO. And like Steve Jobs, 83% of Apple's market cap is after Jobs left. So these guys toiled around in a long time as building a foundation, not totally in oblivion. But once they built it and it was square and sturdy, boom, you could go straight up with it. And that, I think, is really the business case study here in the book. It's not just the book about investing, but really about an idea, a vision, sticking to it, being patient. And even Bogle, he said the years of struggle were really rewarding. The years where the fish jump in the boat don't do much for me. So I think I want people to take away that message as well. I think this book is bigger than just mutual funds, as you read. I think there's a really interesting case study there. But just like Apple completely changed all of tech, Microsoft immediately came out with their own little iPad. And Bogle did the same thing. But I also say he was a cross between Steve Jobs and Martin Luther. Martin Luther, obviously started the Protestant guy, put that thing on the church, and he challenged the church within the church. And he made good points, and he created a whole sort of religion. I think Bogle did the same thing. I think he created like Bogleism, which is low cost, simple. And he would talk down and challenge the industry from inside the industry events. And so I do agree that he made the products that were practical like Steve Jobs, and he also created something of a religion. that I think will be around for quite a long time, because it's like good religions. The people feel it works for them, and I think that's what Bogleism does. It's not about him; it's about the people win. And so
Yeah.
I think this guy is, I try to be out first, but I think there'll be many books about him, and I think he'll go down as like one of the all-time greats, if not the most impactful human for the investor and even the financial industry in the last 100 years.
Yeah, it was very interesting to read in your book that the creation of the first index fund actually wasn't associated with the efficient market hypothesis. And to me, it was quite surprising because actually Bogle, as I could read in your book, hadn't even heard of it when he started Vanguard. So actually, that wasn't the major trigger to him that there's efficient market hypothesis. He was actually even an active manager before Vanguard in Wellington Fund. So actually he had nothing against active investing as such, right? He was just saying that cost is everything.
Yes. His son was an active manager. Vanguard has plenty of active funds, and the Wellington Fund in particular gets the most coverage in any of his books, and that's active. So he was what he really, and he wasn't even necessarily anti-high cost. If you're starting out and you are a small firm, you may need to charge 1%, because 1% on $1 million isn't that much, and you need it to keep the lights on. What he was really railing against was if you broke your fiduciary duty and you were a bad steward of other people's money. And that definitely started to correlate with the active mutual fund world, because they kept that 1% fee even though they had $30 billion in the fund. And that, if you 1% of $30 billion is an absurd amount of money to run a fund. They should have lowered the fee as they got bigger. Still would have made a lot of money. And I think that's where they missed an opportunity. And Bogle, that's what Bogle did. He kept lowering the fee as they got bigger. And he really, really built up trust and goodwill with the clients for that. And that's why he did it even with his active funds, which is why another theory in my book is if indexing never was a thing, Vanguard would be the biggest active mutual fund company 6 times over, because their funds would be cheap, way cheaper, and they'd be bringing a gun to a knife fight. And they might not win every year, but over 30 or 10, 20, 30 years, the Vanguard funds with active funds would slowly rise to the top simply because they were cheaper. And I call that Bogle metrics. Bogle, when he looked at active funds, he was less interested in the exact strategy and the formulas as he was in the costs and how much they traded. So he wanted to remove turnover and expense ratio. Just like in sabermetrics in baseball, they look more at slugging percentage and on-base percentage than batting average, which is more sexy. So I look at Bogle metrics are how he approached active. But he wasn't anti-active or even high cost. He was just anti being a bad steward. It just happened to be that over time, I think the active mutual funds, when they got really big, he accused them of being bad stewards because they weren't sharing economies of scale. And also, I think if Fidelity, if like these big companies had passed on more of the economies of scale and lowered the fees, they would have been better performers too. And I think the active name would be better, because right now active's got this bad name of like they're inept, they can't outperform. If they had lower fees, they would have banked goodwill and performed better. And I think Vanguard wouldn't have been nearly as disruptive. So it's also a business case study in making sure you aren't disruptible. Active managers made themselves very disruptible by, I think, the money was so good, it was hard to, I understand. I mean, you get a lot of money, you want to expand the company, hire people, give yourself a raise. That's why the book's on this guy. He was different. And he definitely wasn't anti-active at all. Although over his years, he definitely leaned more into the index fund. He just thought that was probably the better way to do it. But one more thing on the active thing, Wellington Fund was a fund he ran at Wellington, and then now it's under Vanguard. That fund came out 100 years ago. Right, so it's 100 years old. There's about 10 funds that I call them like the early pioneers. And of all those 10 funds, Wellington has like 90% of all the assets of the early 10 funds. And it's active, which in my opinion, I think proves my theory that if indexing was never a thing, Vanguard would crush and be massive in active funds. I think the Wellington fund, being the biggest of those early guys, is a good indicator of how Vanguard would have done as an active manager only. It's also a good indicator of how big Vanguard could eventually get. Wellington, again, yeah. Wellington under Bogle's care for all that time, again, you do the math, 90% of the assets. The other ones, a lot of them faded away, busted, got merged. The ones that are left don't have much assets at all.
So why Bogle was so much against ETFs? And actually, when he stepped down, I believe in 1996, the first ETF launched by Vanguard was like 3-4 years later. And you even have a chapter in your book titled Bogle and ETFs, It's Complicated. Why he was so much against that idea?
Yeah, it is complicated because ETFs have really distributed the concept of indexing greatly. And even some of Bogle's closest friends like ETFs. They think, they try to tell him, Jack, this has really helped low cost and indexing. But the problem with ETFs, he didn't like the trading. He didn't think you needed anything intraday trading. So it was just against his whole thing. He wanted low cost and he wanted you to hold it for a long time. So the idea of taking an index fund and trading it just seemed like against his religion. I equate ETFs. I think like the index mutual fund for him was like his firstborn daughter. And once it got ETFized, it was sort of like she marrying the tatted up bad boy. And so here, it was always, now you've got this thing in the family, and he had to deal with ETFs. And on one hand, he would say something like, well, broad market ETFs are fine as long as you hold them. But then he'd be like, well, but do we even know people are holding them? Because the trading volume is pretty high in ETFs. So he could never, ever get comfortable with them as a concept. And, that really created a lot of friction between him and Vanguard, the company, him and his protege, and him and the whole industry. And he never really got settled on that. I think he softened a little as the years went on. And he saw that Vanguard ETFs were really low turnover. Not a lot of people trading those. I think that gave him some comfort. But yeah, he wasn't a fan. I talked to a lot of advisors and people who really like him. They're long-term investors. Most of them do not feel tempted to trade ETFs. Like they have enough discipline to buy VOO and like just hold it. So I tried to tell him sometimes that the volume in an ETF could trade like, say, $100 billion in a year. But like 90% of that could just be some big institutions moving it around a little bit. And like 90% of the people in it could just be holding it. You don't know. Volume is not a number you can like unpack. But he would just look at that blunt volume number and say everybody's trading it. But it's not true. Not everybody's trading it. So he acknowledged that, but he still couldn't get over the volume numbers being so big. He didn't like it. So I always tell people, if you think just because you can trade an ETF intraday that you're going to be tempted to trade it intraday, don't use an ETF. But if that isn't a problem for you, ETF's fine. In fact, they're easier to access in many ways. They're trade no commission. So you buy it free of cost. They're cheap. There's no problem with that. But, to his point, if you can't handle temptation, maybe better to just buy an index mutual fund instead.
And what do you think about all these, let's say, non-plain vanilla index ETFs like smart beta ETFs and actually the active strategies which are wrapped with the ETF label? Do you think sometimes that it goes too far or it's a good direction? Because what it was also surprising to me is that even Bogle in the 80s, he was a pioneer in the quant strategies. So he was actually creating such strategies. So we can say that it was the first beta fund. Smart beta fund. He just invented in the 80s already before even ETFs were invented.
Yeah, this is a fascinating part about Bogle. So when he was launching the Vanguard Index Fund back in 1975, he quickly saw that, man, you can actually have index funds that track bonds, international markets. You can have index funds that track the value half of the S&P 500, the growth half. And so he launched a whole bunch of funds. And a lot of people like that. If you really like growth stocks, VOOG, I think, is like, or VUG is growth, and then like more concentrated growth. They're both under 5 basis points at this point. So it's pretty good. You can get smart beta ETFs for very low cost. His problem, though, was over time, he just sort of, he just saw that there's just no way to win. And he got settled into this concept that, you know what, everything's just a distraction. Just buy the total market index fund and don't ever sell it. And you'll beat everybody, or buy the S&P 500. But this idea of like trying to buy value and then growth, and people were buying it at the wrong time and ended up not outperforming the S&P. He just soured on everything, even things he launched, which I thought was really fascinating, that this guy pioneered all these areas and then took a crap on them later.
Yeah.
And that also caused friction between him and Vanguard, because Vanguard is sitting here trying to sell these funds and like their clients own them. And here is the old guy in his campus office saying, this sucks, you don't need it. International is a great example. Most people are like International, and you can now get it cheap International through Vanguard, but he said there's no need. And so that's also something very interesting about this guy, is that you just got the feeling he just didn't care about the money. Like because if you really, he just spoke his mind, and to come to this simple answer of just buy the total market, the beauty of it is it's so easy to do. But this guy went through this whole journey to arrive at this sort of nirvana space of total simplicity and low cost. And now anybody can just skip all that journey and just buy it and just trust the guy. But you don't have to. You can do other things. A lot of people who are Bogle heads, they do International. And maybe they have a little value stock exposure. It's not illegal. It's okay. But he certainly was almost dogmatic in his simplicity at the end. And that put him at odds with everything, which is like, again, I was fascinated by the story in that he was frictioning, he was basically in these war of words with his own company on the campus. And I don't know, just an interesting guy. He was just lived he just kind of like spoke his mind and lived in this tension with the whole industry and his own company for a long time.
But there are some worries about passive investing, and some of them are maybe just not really worries, but there are some worries which were even worrying Jack Bogle. For example, that the bigger the Vanguard was becoming, the more votes they had. And for example, now the big three, the BlackRock, Vanguard, BlackRock, and State Street, for example, in Apple, they have like 15% shares, the votes. So basically, there's a question, what then? I mean, if they will start controlling more and more the companies, what such big companies will do with it? And is it somehow really changing the market that we have such a big players which are really having a big amount of votes?
Yeah, this is probably the one thing that is ultimately going to get regulated. The rise of indexing is way over. Like, people fear-mongering on so many things. It's all bullshit.
Yeah.
The one thing I think that's going to actually be a legitimate point over the years is how much does Vanguard and BlackRock own of most of America's companies? Right now, Vanguard owns like 8-9% of most stocks, and BlackRock's another like 6-7%. And ultimately, that's going to grow because they take in the vast majority of all the new flows. So you can see them at 10-20% of ownership of companies. That's a lot of voting control. The government's probably going to be concerned about that. So that's why we have a theme that we read about a lot in our research, calling the only thing that can stop Vanguard is regulation, in our opinion, and it probably will happen. I asked Buffett about the same question. He said, it's fine, I'm not really worried about it, but it's probably going to be a regulatory issue for another day. So I do think somewhere along the lines, they might say that, Vanguard and BlackRock have to just stop taking assets in. Like, it's over. The rule right now is a fund can't own any more than 10% of one stock. But a fund company, it doesn't apply to it. So their total market fund from Vanguard, I think, owns 3% of Apple. So it could grow 3 times and still not hit that ceiling. So Vanguard could effectively grow 3 times as big as it is without really having a problem. and then they could just open a total market part two fund. So you could see how they could just keep going and going. So that's why I think some government rule regulation is probably going to have to come in. That said, I don't think they're horrible voters. I think they vote pretty neutral. They try to vote with management most of the time. And when faced with should the CEO have like performance metrics, they usually say yes. So I think they are careful to vote in a way that would help all of the shareholders in the index funds. They have corporate governance groups. They look at each vote, take it seriously. Some people on the right think they're too ESG, and some people on the left think they're not ESG enough. So they're constantly getting attacked from both sides, but I find them to be pretty okay. I think, and there's a good deal of people who use their funds who don't care. They're like, I just honestly, I want the cheap index fund. I trust them. It's a big media story, but I think it's probably the one thing we're going to keep hearing about, and the one thing that probably will cause regulation. But it has nothing to do with active and passive. It's just the fact that one company and two companies are having that much control. It has that monopoly type feeling that tends to cause get regulators and legislators attention in the U.S.
All right. I'd like to talk about the art of doing nothing, as you described that in your book. We all know the Big Short, but you were writing about the Big Long, and you claim even that the young day traders will eventually convert into conservative buy and hold investors. That actually happened to you as an investor. So you also were a day trader, maybe short-term investor, and you converted into the long-term conservative buy and hold investor. Could you please elaborate more on that? Because that's interesting, I think, especially now, because even when I started investing in Europe, ETFs were not that popular, but now I see even young people which are already starting with passive investing and just starting being very conservative because they already had a chance to read about all this bullshit with this day trading and stuff, and they are already from the very beginning focused on the long term.
Yeah, young people in a bull market, their friends show them the phone, look, I'm up 3% today. And you go to a bar. Same thing happened in my generation. It was stocks like Oracle and Cisco and Microsoft. The stocks would be really powerful. And in the 90s, we were into it. But then there was a crash, basically, a bear market. And we realized it's not as easy as we thought. And then we also, started buying houses, getting married. And you realize you can't just trade your money away. So I think it's a young person's game. But it's okay if you're older and you want to trade and you look at it as like recreation. It's legal. I have no problem. I mean, it's fine. I just think overall, young people don't have the experience of a bear market to know that they're not geniuses, and it's harder than it looks. And so I think that's what's going on with the meme stock crowd and even some of the crypto people is that the Fed was like pumping up the market. It was a very good time to be an investor. Everything seemed to go up a lot. Now I think that retail percentage of trading is coming down. I think a lot of them are like throwing the towel in, surrendering. And I think a lot of them do end up at low-cost index funds, which to me it makes being long-term investor easier. I think the big long advisors, as I call them, are advisors out there that are younger, they're fiduciary, they use index funds, and they tend to really interpret news flow as like trying to bait them to do something. And they're like, I'm not, they have just learned to just hang in there. But I think also just having a low-cost index fund makes it easier to hang in there. Because think about it, the market goes down, you're in a 3 basis point total market fund. You think to yourself, in the 90s, you'd be in an active fund and you think, well, I should go to one that's winning, right? And then you switch, at the wrong time and you're constantly buying low, selling high, or vice versa. Having a low-cost index fund makes it easy just to not ever do anything. Because what are you going to do? I think they come to this resignation, even in a bad market, where, okay, I'm down 16% this year, but I'm still up 13% annually the last 10 years. But what am I going to do? Am I going to take my money out of this 3 basis point total market fund and like chase somebody doing well this year? Well, maybe, but I've seen over time that person's going to do bad the next year. screw it. And I think they just come to this like resignation of like, I got the best deal, no friction. I get to keep all my money. I own all the stocks. I realize I don't know the future, and that's it. It's over. And that's how I think he won a lot of hearts and minds of investors and advisors. But it's only can be done if you have a cheap index fund. It's way harder to be well behaved if you own some stocks, single stocks, or if you're in an active mutual fund that might not be doing it. Maybe it's down worse than the market. Then you start to panic. So I give him a lot of credit for helping behavior for a multitude of ways. But it is tough to behave because you've got the media sort of fans the flames of like FOMO and like fear, and you feel like you should do something. And then also with commission-free trading, it's so easy to trade now. So there are definitely some things that you have to overcome to be a good behaved investor. But he made it way easier, and he brought a lot of attention to this concept as well. So I think the art of doing nothing is it's what I call the art. It's not that easy. You have to really develop it. But he made it much easier. He deserves a lot of credit for helping behavior, in my opinion.
Right. I wanted to ask you also about the American ETFs and European ETFs, because most people in Europe don't have access to US registered ETFs for regulatory purposes in the European Union. And I wanted, so for that reason, for example, Vanguard and also BlackRock, State Street, they are launching ETFs registered in Europe. Do you think that Vanguard is able to do the same thing and do the same thing to competition, which did in the US, but on the European ground? That, for example, will really force the big players, especially the active mutual funds in some countries, they have very, very high fees. Do you think that Vanguard can really go country by country and really beat them and make the Bogle Effect in Europe, for example?
It's a great question. And I try to approach this in my book because it hasn't taken off nearly as much in other countries. First of all, Bogle was here, so he was in the U.S. himself. There's no real type Bogle characters out there. The other problem that I think you have in other countries is the system still is based on commissions to brokers, and the advisor feels their big value add is to pick active managers. In the U.S., the advisor, which controls $26 trillion, the advisors are now, they go to a fee-based fee where they get a percentage of your assets. That naturally inclines them to buy good stuff for you because now it's coming out of their money too. And there's less of those type advisors overseas. Ultimately, when that spreads, it will definitely help the Vanguard movement, in my opinion, because of that. So that's one reason. The other reason is, people in the U.S. have had to get a little more wise about what investing is because we have 401ks here. So the U.S. kind of put retirement on us. So we have at least some sense of like what a fee is, what a fund is. We read about it a little bit. Our 401k plans have this list of funds. We have to find out what they do. You don't really have a ton of that in other countries. There's more pensions. And so I think the retail investor there is less wise to some of this than they are in the U.S. And that's also a hurdle. But I think over time it will just happen. It's interesting that the difference between an active fund fee in the U.S. to a Vanguard fund fee is about half that as in Europe. And
Right.
yet in Europe, they're less reactive to that. And I really have explored why. And it is part of this just culture of, I don't care, the incentive system there. There's a couple of reasons, and we explored it. But they really should be a little more alarmed. So because we completely freaked out here in the U.S. and the gap is way smaller. So I do think over time it will probably help because I think at the end of the day, like that chart I told you about at the beginning, you'd rather have $350,000 than $150,000. I mean that's pretty universal. So I think ultimately that will happen. It's going to take a while.
Yeah.
And there are people who are Bogle-ish over there. They're not quite, as big as he was. He was a huge force. But there's definitely little Bogle-inspired people in other countries, and I think that'll help. And Vanguard is was late going overseas as well, so they were a little late to the game. So it'll take a little while, but they're having some decent flows in Europe and in Australia in particular. Um, but yeah, I ultimately think Bogleism and low cost will ultimately sweep the whole world. I mean, it's going to
Right.
happen. It's
That's a
just
good.
too logical. It's too good for the consumer to not happen. It just it's just going to take a while because
Understand.
I feel like you guys and other people are like where we were in the '90s. It's just a little delayed.
That's a very good news. So let's hope that indeed Vanguard and others will continue that work. Just I have one of the last questions before we will quit today, because some people in Europe, even if they have access to American ETFs, they are not really interested about them for tax reasons. Namely, in Europe, we have so-called accumulating ETFs. So if the dividend is paying out the dividend, in fact, the dividend is automatically reinvested within a fund. And for that reason, there is no tax. And especially in Belgium, for example, the dividends are taxed on the 30% level, which is a lot. So for that reason, people prefer to have these accumulating ETFs, which are not existing in the United States, because each ETF is distributing that dividend. Even if you put that it automatically is reinvested, but it's not reinvested within the fund, it just buys more units of that ETF. So do you think that in United States, the providers are even aware of that issue, or they care about it, or they don't care about the people from Europe because they know that still, it's limited access to these ETFs, so
Does
they
that
don't.
rule does that rule you just described apply to mutual funds too?
No, because the mutual funds, if they pay out the dividend, it's within the fund, and then there's no tax. So
So
for
the
them, it
ETF,
doesn't.
the dividend comes out, and you have to get it. You can't just reinvest it without getting taxed.
You are taxed if you get cash on your account. Then you have to pay tax on it. There are countries in some European countries where even if you don't get the cash, you still have to pay the tax. But most of the countries, if you don't get the cash, it's reinvested within a fund and there's no tax.
Yeah, well, that could definitely slow it down. I think in the U.S., ETFs are better for taxes than mutual funds, and that helped them. It wasn't the only thing that
Understand?
helped them, but it was, I would say, it's a top three benefit. Yeah, no, that's definitely a hurdle too. I don't know, it just seems like not right. I feel like you should get taxed when you sell it.
Yeah.
That's the idea of taxing it for something you didn't do. It just seems like
Yeah.
I don't know.
Yeah.
That's how mutual funds are here. You get taxed even if you just did nothing, and I think it's interesting. Yeah, that could definitely slow it down. Hopefully, they'll fix that. That seems like a rule that
They are
you get
fixing that.
BlackRock and you get these big companies over there. I'm sure they'll work with
Yeah.
regulators to try to solve this.
Yeah. Yeah, yeah. And by the way, you have another great book, The Institutional ETF Toolbox from 2016, which I read as well. Just a question, are you going to update it, maybe even extend it by
Yeah,
European market?
it's a good question. Yeah, I probably should. It still holds up. I put mostly fundamental things there that are evergreen, but yeah, there's some ETFs I talk about that have closed, some new ones that have come. I probably need to have an update. Yeah, it's
It,
probably very possible my next project, book-wise, is to update
it's very
that book.
interesting, your perspective, because while you're working for Bloomberg, you have access to great data. You can present really nice statistics. It's really interesting. Therefore, I think it would be really very interesting to have such book also for not only for American ETS, but also for maybe European, Australian, I don't know. By the way, do you have any plans for other new books?
Not right now. I was just talking to a guy in my department about book writing, and I was like, you're ready to write a book when it just gnaws at you and you feel like this thing should exist. The world needs this. And I felt that about my first two books. I don't feel like that about anything right now. So I don't know, is the answer. So until I feel that gnawing feeling like this has to get out of me, I will not write one because it's painful. And you need to
Yeah.
see that in order to get through the pain and the struggle of it, you really need to want to say it. And I don't really feel like that right now. But it'll something, The time between my two books was about 5 years.
Right.
So maybe in another couple of years, something will just naturally come out where I'm like, this needs to be a book.
And by the way, I heard that the Bogle Effect originally had 600 pages, I believe, and you reduced that by half.
Well, it was 500, and I got it down to 340.
Yeah,
Yeah, it
my
was
God.
500 pages. Yeah, I like to overwrite, and then edit and cut and cut and cut, and try to just make sure that I take all the fat out. So I work with my editor to try to get it tighter. But yeah, it was long at first, too long. I had a whole chapter I removed. I went over how like passive portfolio managers manage ETFs and mutual funds, and how they do securities lending, which puts money back in the fund. I call it the game of basis points. And everybody I gave the book to in the early form said, this is just a little too wonky and boring for me. So I killed a whole chapter. It hurt, but I think it's good to overdo it. Like when you read about good bands, they usually write 30 songs and they take the 10 best ones, rather than just saying, oh, the 10 songs we wrote are obviously very good because we're such a good band. I just don't have that kind of arrogance. I don't think I'm that great. So I want to write a bunch. Somewhere in there's some good stuff, and somewhere in there's like boring stuff. And I think that's my process.
But that topic was actually very interesting to me, regarding tracking difference, because actually they proved that they can give you the stable extra profits, creating almost free ETFs. Even if you pay something, actually the tracking difference is working for you because of that security lending, for example.
Yeah, this is a huge point. Like VTI, it basically has zero tracking difference. So in other words, the securities lending they're able to do, they get a little fee from that, and they put it back in the fund, and it eats up those 3 basis points. And I still stand by that being important. But for most people, the idea of like explaining to them that like, oh, you're actually paying 0 instead of 3. They're already so happy at 3. It's like, this is just getting into like really niche areas. And so the common person, it's not a big deal to them, even though I find it exciting. But
me too.
I think it's just, yeah, I know. And I flick at it in the book. And in my first book, I go over tracking difference quite a bit, but it just didn't play well here. And I had to listen to the people because I didn't want, at that point I was too subjective. I needed to really hear what they said and be like, okay, all right, I'll let that go.
Okay, thank you very much for your time, Eric, and thank you for your great books. So what's the best way to find you if someone would like to contact you? Twitter?
Yeah, my DMs are open. So just go to @Eric Balchunas and you can just hit me up with a DM, and I will, some DMs are ridiculous. Like it's people trying to sell you NFTs, but if it looks like a normal DM, I will reply.
Sure. Okay. Thank you very much for your time.
All right. Thank you very much.
Great to be here. Thank you. Bye-bye.